Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now let's start this episode with some numbers. In financial year 2023, the ELSS fund saw inflows of 7,744 crore rupees. But this financial year, it has trickled down to 1,040 crores only. And with this new budget and the new tax regime gaining strength, these funds are likely to get fewer takers. But the question is, have these funds lost their appeal, or are they still investment worthy? We'll talk about that in today's episode with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First up, let's begin by discussing the case for ELSS funds. Who should still consider investing in them and why?
No, the case for ELSS fund is very simple, very compelling, and particularly to my likability. I'll tell you why. This is the only tax-saving fund, tax-saving avenue, which gets you growth. Everything else gets you fixed income. So you don't get wealthy. Here you have the potential to become wealthy over time. Second is that, because you invest in a tax-saving fund and it is an equity fund, you get stuck for 3 years because that is the design of it. And when you get stuck for 3 years, you end up being a winner. Because the real problem of investor not winning with mutual fund or equity fund is that they come in some weather when it is very exciting, and then it becomes very unexciting. They lose, they get disappointed. It should continue, and many investors, for them, if some rule is framed that the first investment in equity should be in a tax-saving fund, it may not be a bad idea, because most of the time investors themselves hurt themselves by investing and having a short-term time frame and looking at NAV every day, investing in a thematic fund, investing in something exciting. It's not exciting. You have to get used to acclimatizing yourself with equities. This is the finest vehicle, and I know so many people over the last 10, 15, 20 years who started their savings or investment potential was only in the tax saving fund. They could not invest anything more. And if they continue doing it in a disciplined way, they are wealthy. They have been able to create the retirement fund entirely because of the tax saving fund investments.
But with the new tax regime coming in and ATC, no mention of ATC being there, what's the point in tax saving?
No, in the new regime, there is nothing.
Yeah.
Lower taxes, simplification, and no tax saving investment or no enablement of anything of that kind. This is where I think, tax saving was a great, sop for investors or savers. It was encouraging them. And I think more than encouraging, more than, giving them the tax benefit, it was more of a habit forming, habit catalyzing, feature. So that is very disappointing. There should be something, and there is still something, but that is in a different form. If NPS is made mandatory in place of Provident Fund, that could be one thing. Increasing the limit there, because that is the only thing. NPS is the only thing which is similar to ELSS with a longer lock-in, which can get you potentially similar return. But ELSS was looking very attractive. It was a habit-forming thing. And in the new tax regime, there is room for no exemption. It is a simplified scheme. You earn and you pay this much tax, which is lower than your old regime.
So do you think these funds will slowly phase out?
They will continue till the old regime continues. And if ATC is done away with, then these funds will continue till till the money lies there, because it's an open-end fund. And the money has a lock-in, investment has a lock-in only for the first 3 years. Right. So for all practical purpose, these funds actually become a normal, diversified equity fund after 3 years for any investor. And that is what they will become.
Okay. Can you please elaborate a bit on their historical performance compared to other investment avenues?
Oh, it's very straightforward. It is, twice as much as the Public Provident Fund, which is the most comparable thing. And Public Provident Fund is something like a barometer of the fixed income return in this country. Little higher, not lower. So if you look at it, these funds have been able to, in the worst of times, they have been able to give 20% more. In the best of times, they have given 2.5 times more. Just for sake of, hypothetical calculation. I did one exercise many years back, and I think the numbers would not have changed because it is very, very long term. If you do your 1.5 lakh rupee investment in public provident fund, which gets you 8TC and gets you guaranteed income and gets you guaranteed income in this country, which can't be any more, any higher than that, more safer than that, then it was accumulating to something like 28.5 lakh rupees. Give and take a little bit, because I'm just trying to recall from my old calculation. In that period, the worst tax saving fund was yielding for periodic 1.5 lakh rupee investment for 15-year period. The corresponding worst equity fund was yielding about 48 lakh or 50 lakh rupees. And the best fund was yielding 1.82 crore. So, and the median was somewhere around 85, 86 lakh rupees. So this is the difference that you see. And when you are thinking long term, it has to be equity. In that sense, it is a great deprivation for people. It was actually a free coaching institute to learn equity investing and, lose your fear out of it.
All right, so finally, will they still remain relevant?
I think they will remain relevant till old regime continues. Reason is that new taxpayers, they start at a very low level. And new tax regime gets attractive only after you cross a basic threshold. And new taxpayer who have lower income or less income, and they also have a lot of entitlement in terms of borrowing for the home loan and this and that. So for them, it might be relevant. But if tomorrow, the way it is going, that 2/3 of the tax filing, the assessors filing their tax return, for them, the new tax regime is more attractive. It's an optional thing. So for all new investors, this your old regime will remain attractive in the initial years. And in the initial years, do your tax saving investment in ELSS so that you get used to it. It's much more than just your investment doing well. Forming a habit which will become very rewarding in your life is very crucial.
All right, so that's about the ELSS funds. Now, here's a viewer's question. I have a surplus of 50 lakh rupees in a liquid fund, which is not required for at least 3 years. I can take maximum risk for highest return for next 3 to 5 years horizon. Where shall I invest, in lump sum or SIP?
One is that 3 to 5 years is not a very long period. So be conservative about it. You can take all the risk, that is one part of the story. But you would not like to lose any part of your capital. And the likelihood of losing a part of your capital is very high if you invest lump sum today. I will give him a framework, 1 or 2 rules which he should follow. One is that he should invest only 15 to 30% into equity. So that the remaining 70% or 85% which will be invested in fixed income in a short-term debt fund. So that worst case scenario, even if equity is in a bad shape, the debt will return, grow to an extent that he will not have great regrets. It will become 50 lakh rupees. Second is that, that remaining 15 to 30% which will be invested in equity should be invested over the next 6 months or 1 year, depending on, how comfortable he is. Not lump sum. And he should diversify. That is the only free lunch available. Because, something will do well, something will do poorly, and don't take a bet on anything which is, anything exotic which is going on.
All right, then that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.